My, oh my. Has there ever been eight, seven, it's seven, because me and Christian are on the same team. Has there ever been 7 stablecoins ever on the same panel in the history of crypto? I believe this is a world's first.
Now get us physically together.
That's next. That's next. This, if everyone loves this, then I think we do a 2023 stablecoin summit in person focused on decentralized finance and stables. I think that would honestly be awesome. So to kick things off, I think we just do 20-second introduction. Who are you? What's your role with your project? And then right after we do those quick intros, I really want to just get down to some deep questions that are only viable when you have this many very in-depth folks in the same place. So we're going to cut straight to the chase, none of the fluff, right to the hard questions on stablecoins. So Sid, if you want to kick us off, 20-second intro, we'll just go one person at a time.
Hey, Carter, thanks. Hi, everyone. I'm Sid. I'm one of the co-founders of Comdex and also Composite, which is the stablecoin that we're building on the Comdex chain.
I'm Dean Tribble. I'm CEO of Agoric, which is a platform for smart contracts. I helped design IST, but it's launched, and now I can tell you lots about it. But it's controlled by a community now.
Dove?
Cool. Yeah, I'm Dove, and yeah, much like Sid, a co-founder. I'm a co-founder of Kujira, and yeah, nothing more needs saying.
Christian?
I'm Christian. I'm head of engineering at Shade Protocol and also the lead engineer of Shade Lend.
Awesome, Stefan.
Hey, I'm Stefan, founder of NUON. Yeah, a flat coin, which basically think of it like a synthetic peg to the cost of living.
Awesome.
I'm Sam, founder of FRAX Finance. FRAX is a 2 stablecoin protocol, FRAX and FPI.
Hey, I'm Tadeo. I'm the facilitator for the Data Insights Core Unit, a team that is involved in all data-related projects at MakerDAO. And our stablecoin is DAI, a over-collateralized crypto asset backed that is currently going on to now real-world assets and other endeavors.
Awesome. So every builder here has an ethos of decentralization. Simultaneously, I know at the heart of stablecoins is a yearning to get Web3 truly adopted and integrated into our everyday lives. So that is my first question for all of you. It's 2022. You know, the advent of smart contracts around 5, 6, 7 years. Like, right? How many years you want to pick? My question is, why have stablecoins not penetrated back into everyday commerce? Whoever wants to kick it off, let the chips fall where they may.
Yeah, I actually have a good view on this. So I actually think that stablecoins, just unanimously overall as a concept, are one of the points in crypto that has product market fit. Now, maybe not in real world commerce yet, because there has to be merchants that accept it. But I think there's very few people that would argue that stablecoins are not a good idea or are not something that actually brings value to everyone. I think the more interesting aspect here is, as you said, the decentralization and the types of stablecoins, right? Like on this panel, we don't have any fiat coin to my knowledge, unless someone here is a fiat coin. But basically, the two kind of designs that I just, there used to be 3 designs, like, with the algo stables and stuff. And I think a lot of that's just merged into the idea of having on-chain collateral versus having fiat collateral, right? And so the more important thing is this stablecoin trilemma that I always talk about, which is, in order for stablecoins to really get into the mainstream market, there has to be a clear understanding of what the trade-offs are for different designs. Otherwise, there's going to be just this constant, jostling of, the fiat coins versus the decentralized stable coins. That, to me, the most interesting aspect of stablecoin design in the next 1 to 2 years is who solves and what will solve the stablecoin trilemma, personally.
Yeah, that's a very good point, Sam. I just think from a simplistic point of view, and ourselves included, I guess, I wonder if it's also just the temptation to be always sucked into the blockchain realm. And as I say, I'm speaking for the whole. Well, not that I can speak for the whole space, but I just mean from what I've seen. I wonder if there is always a temptation to kind of, keep within the blockchain space and to make sure that that works really well. And as I say, we've been guilty of it, and I wonder if we all need to. I don't know the answers, but I think just pushing, even if it's a tiny thing, like trying to find some vendors on the ground and in emerging countries that can hit the ground running with commerce payments. But then, you always have the flip side of that, right? So you can always make the transaction, but then somebody needs to kind of get fiat out the other end at the moment. So yeah, this is kind of where I feel the tricky bit is. It's okay to make a system that allows stablecoin as payments, but then what do you do beyond that? So that would be something I'd be interested to hear all your guys' point of view, right? Is we don't want to just be the kind of on and off ramp for people to go back into that same system, right? So I'd personally be curious to hear how we can all put our heads together and solve that, because we've had conversations with exchanges, for example, centralized exchanges, shall I say, and they are looking at just becoming on and off ramps ever since the whole FTX drama. So we should probably be careful not to become that same thing, right? Like we build these amazing systems and then we're just like the kind of on and off ramp. So anyway, it's more of a general topic, because that's probably something to be wary of, I imagine, for all of us.
So there's also, mostly crypto's early in mainstream adoption. A lot of our focus is how do we get to mainstream adoption through developers. But, stablecoin, credit cards work pretty well at the consumer level, right? For wire transfers and international payments, not so much. That's the place where there is vast cost, vast bureaucracy, vast pain. And stablecoins have an opportunity there, modular. They're going to have to solve the regulatory kinds of questions in order to integrate into those mainstream cases. The other thing is, right now, it's only relatively recently that we're able to tell the difference between, solvent, robust stablecoin models and experimental, interesting ones, or ones that, no, for years people said, the UST model is crap. And, oh, look what happened, right? And so from the outside, they're going to want to really care about solid, robust models that they can rely on if they're going to transition to using that. A big speed / price advantage is good, but it's also got to fit with, if I'm a shipper, I've got all sorts of, regulatory and reporting requirements and stuff like that. And, you want to integrate into TradFi, you got to solve some of those problems. I think there's a good synergy there and a lot of value we bring to that multi-trillion-dollar market. But there's more work to be done, and we're just at the beginning of that.
Yeah, I think these stable coins have gone through an interesting journey, right? You look at Tether. It came out with Binance, right? Binance didn't have any fiat and on-off ramp, right? It was Bitfinex that helped them get Tether and then build the liquidity associated with all the trading pairs and then with the other exchanges. Then you had USDC come out, and they really also provided the liquidity across the EVM networks with the DeFi Summer. And so all of a sudden you saw, but these were both centralized entities that really sort of came out and under a decentralized sort of framework, came out and created awareness of this new product or novelty product called stablecoins, right? And at the same time, I worked at Bitcoin.com. I was leading Bitcoin.com over there, and we scaled and tried to make peer-to-peer payments work using Bitcoin, Bitcoin Cash, and Ethereum. And it was really difficult because people don't want to be that person that spent, X million of dollars on a pizza. Because I spent, regardless psychologically or not, you converted it into a stable coin and you spent that money buying a pizza, or you actually spent the Bitcoin. But psychologically, you're spending the Bitcoin, which will have value tomorrow. That was just not going to happen. But I think now, with inflation as high as it is in most markets. In the UK, it's up at the 18% if you use maybe more believable data. In the US, we're at 6%. Argentina's living with 100%. Turkey's living with X, and ultimately, if you look at the currencies that we're using around the world today, they're all digital anyway. Who uses cash today? I mean, we use cash for micro transactions, maybe even coffee we pay without credit cards, etc. So do we still need those off-on ramps? What we do need is POS integrations. So is there a way for us to work with point of sales integrations, not proof of stake integrations, with point of sales integrations, right? So getting on with the all of the world payments, all of these guys that are building out and distributing payment solutions, CryptoPay, AnyPay, Clover6, coin payments, etc. Can we build a network with those entities and those individuals and get them, if they're not already adopting ERC20 or Cosmos chain solutions, how can we get them to adopt multiple different currencies? Because for them, the swapping in and out is no problem. And for them to provide the payments and the settlements shouldn't be a problem. It's the conversion into the national currency when they need to pay rent or pay. But those lending facilities, think about it. So the Bitcoin miners started off having pay. They were earning Bitcoin and they had to pay in fiat to pay for their electricity costs. They had to pay in fiat for rent. That's how the whole lending mechanism grew. Can we build new lending mechanisms around stablecoins with these POS vendors in the middle to then provide the liquidity to the necessary merchants so they can pay their electricity bills and their rent if that is still needed to be paid in fiat? That's, to me, the value chain that I think we as a consortium can help sort of grow as a community or as a constituents in that community, helps really scale.
Yeah, I think essentially we need to be able to get stablecoin projects in touch with point of sales folks and actually build those rails. And I really like the point of, to Dove, your point, like recreating. Do we really want to recreate on-ramp, off-ramps? Like, is that actually, or is there something more here? And the answer is, yeah, of course there's something more here. We all believe that there's something more here than that. So next question here, we kind of talked about why isn't it fully been integrated into commerce. I now kind of want to pivot to lessons on risk. 2022, we saw the largest implosion of a stablecoin that many people believed in. Of course, there's also iron finance as well. So Tadao, Sid, and Christian, I know you guys haven't talked yet, so this question will kind of be pointed at you guys and others can hop into here as well. But what were the biggest lessons learned in 2022 tied to the different stablecoin models? And I'll pose the question, is the dream of an algorithmic stablecoin dead? And what I mean by that is, at what line is collateralization enter into an unacceptable point? Because we obviously have Sam on this call, fractionalized reserve system to a degree, and it to date has worked well and it has a much stronger collateralization than Terra. But like, where is there a line in the sand? What do we think that looks like? It's kind of a spicy question. So I'll open the door. Sid, I know you're chomping at the bit to answer this one. Then we go to Christian, and then we go to Tadao.
For sure. I think it's a very interesting question. Quite a lot of times when I think about the whole UST situation, I feel like if UST was just 3 times as big as it actually was, it might not have ever depegged. It might have been too hard for anyone to actually attack it. And if it did depeg, it would take down way more with it than it did when it did. So it works as long as people choose to believe in it. And that's kind of, where it becomes tricky. I feel like it was a very interesting experiment. I mean, I like to call it an experiment because it was essentially that. It was an economic experiment, which, went horribly wrong for Terra. My bias is obviously towards kind of over-collateralization, because if you look at, as long as traditional finance has existed, and so many things in traditional finance have existed, they all quite heavily rely on over-collateralization, because a lot of times the collateral asset itself is not as liquid when it comes to real-world transactions. When you collateralize a house to take a loan against it, the house is essentially not as liquid as what other assets you could probably collateralize there. So in that regard, it does feel like over-collateralization is the rather safer approach to go for, when it comes to building stablecoin models the way they have been built. And I think MakerDAO kind of, for the time that it has existed, the DAI stablecoin, for as long as it has existed, is proven itself to be quite robust, given that liquidations, do work as they're expected to. So to that regard, my bias still lies towards over-collateralized models. I do believe they're more robust when it comes to long time frames of several years, when you account for many different types of volatilities that markets usually face in that time period. Of course, what's been done at FRAX, I find is very interesting. I've spent actually a lot of time studying FRAX's model, and I was truly very, very interested and intrigued by that. And part of me wanted to kind of, endeavor on that route as well when it comes to when we had to make the decision of building what we wanted to build with Composite as well. But kind of just reading the situation of the market at the time, it just it made more sense for us to go for the over-collateralized route. So I'd say my biases lie in that direction.
So I think I have an interesting view on this. Is the only stablecoin probably on the panel that has any kind of like direct relation to possibly saying we're even part algorithmic. What I want to say first though is FRAX has never broken its peg a single time. Today it's its second birthday. So what we've done is we have a system where part of the assets are backed by hard exogenous collateral, right? Like over collateralized loans, USDC, stablecoins, protocol, and liquidity, etc. And the other half is algorithmic with volatile assets like ETH, FXS, which is the governance token itself of the FRAX protocol, and these kinds of things. Now, what I will say is FRAX is almost actually much closer to Maker and like over collateralized models than anything Terra was. We're actually right around 94% CR. Terra was like 0, and they were trying to actually become more and more like FRAX towards the end of their lives by having a bunch of exogenous collateral, and I don't think they ever really got to anything higher than like a 10-20% CR or something like that, which is clearly not enough, right? And so we know that FRAX at least works for 2 years now. There's empirical data, and this kind of thing with a very, very, very small amount of supply that is backed by volatile assets, right? And then a very, very, very large amount that is backed by exogenous, stable, over collateralized loans, etc. Those kinds of assets, right? So we know that actually works. However, one thing I will say is that I think people get surprised when I say I do personally prefer over collateralized stablecoins. Like they are safer. So people actually scratch their head when I say this, because for example, if all things being equal, if you're provided a stablecoin with 120% CR and one with like 94%, obviously pick the 120% CR. Now, the thing people don't think about is, well, people should prefer a 300% CR stablecoin. It is safer than 120% CR, right? But the cost to creating the money is extremely, extremely expensive to create a 300% CR, right? Like, why doesn't someone fork MakerDAO and say, hey, everyone wants over collateralized stablecoins, right? So we're going to over collateralize this one, and it's 300% CR. It's much safer than DAI. If ETH or DAI or something has a black swan event, this one will still like not be under collateralized, but like DAI might be under collateralized. Well, the answer why no one does that is no one would use this like 300% over collateralized DAI, because to create it you'd have to put $3 worth of ETH and then you'd get a loan, while Maker you can put like a $1.20 per DAI and take out that loan, right? So there is actually some useful and important concept of capital efficiency that I think is lost, because you don't actually want obviously something as messed up as like UST, right? That implodes. However, you also can't have something with 1,000% CR. I would love 1,000% CR stablecoin. Hell, I would use it over FRAX. I would use it over DAI. I would use it over Tether, USDC, but that doesn't exist, right? And so my personal view is that the end state of all of these stablecoins with the most best crypto economics, with the best capital efficiency, is something on chain right around 100% CR, something right around FRAX. Maybe FRAX should approach 100% CR, admittedly, right? Or something right around 98%, 102%, 103%, right around 100%, because that is the technically, by definition, that is the most exact, capital efficient, solvent, and safe and competitive type of currency. So that's actually my personal take on this whole kind of algorithmic stablecoin stuff.
Yeah, thanks for jumping in there, Sam. I know it's the content, because I've listened to hours of you, by the way, which I'm sure many of us have at this point. I know, like, you believe, like, historically there's been a trend towards fractionalized systems because they are just more efficient ways of making markets. But of course, when we exist within this totally digital environment, like, you can't really trend that strongly in that direction, but there's still profitability to be had within the protocol if you are somewhat fractionalized, right? But Tadao, I know you represent MakerDAO, and there might be a different philosophy from your perspective on the risk side. So what's your take on the question of algorithmic, partially fractionalized, over collateralized? Where do you see things heading, and what were the biggest problems you saw in 2022?
I mean, to be honest, I do agree. I do agree. Ideally, we have 100% CR, and also we get to basically absorb any shocks that we have in the system. I think what we're trending towards is, or at least one of the answers, is really diversification. The real problem we have nowadays in our market is like everything is correlated. So when one asset goes down, everything goes down. So like my point here is let's say we look at crypto collaterals essentially as a single asset. So you need to diversify outside of that. So our response to that has really been the real assets going outside, which again, it has its inherent problems and the issues of centralizations and having to deal with institutions. But hopefully us and really the industry as a whole, we're able to onboard these assets and represent them on chain in a way that once they enter, we're able to trade them permissionlessly. In that, it's something great about decorrelation is that something like half of your portfolio, like a significant amount of your portfolio, can decrease in value, but then you're still over collateralized, or you're still fully collateralized, let's say, and then your entire system is working to the point of we have the real issue that we have is liquidity. It's like you need to be able to ensure the maximum amount of liquidity as possible. The moment you have, let's say, lower liquidity, then the value proposition crumbles, the user experience is destroyed, and that's kind of quite tied to capital efficiency in itself. And it's like, do you want to reach the next billion? Well, you can't really, as I was saying, like you can't really ask them for a huge amount of over collateralization. My big, let's say, question is why, all these problems are not really fiat-backed. Stablecoins don't really have these issues that we here have deal with, and yet they haven't reached that let's say mass adoption that we are all expecting there to happen. And to be honest, what I'm kind of happy to have seen this year is really let's say during the Luna craze, it was kind of just like the annoying person in the corner of the room shouting that this is wrong, that this is the wrong model. It's really nice to see competing new models that are actually quite safe, at least by design. Let's say Aves GHO and Curve's also stablecoin design seem to be pretty interesting implementations of that. Similar to Aves' proposal of having, I think they're called facilitators or governors. Maker has a distribution channel for DAI called D3M, which essentially is plugging liquidity straight into other protocols. Again, it has its inherent risk, but there's a separate from again, going for this diversification. We're looking to kind of have different vectors of risk that again, as a whole, you're able to manage properly.
That's an awesome answer. I think it's super interesting, the relationship between over collateralization and capital efficiency tied to depth of liquidity, right? Like there's your stable coin is only as scalable as liquidity, moving with it, right? And growing with it. So before, there's two really big topics I want to hit on this panel. kind of remaining big questions. One of them is regulation, and the other one is the risks of centralized collateral. But before we jump into the regulation discussion, Christian, you're the last one who hasn't jumped in here yet. Specifically, I know you're the one stablecoin on this panel that has privacy by default. So what is the role of privacy and stablecoins in your opinion? And what's that role? And then once you've answered that, we will then pivot over to kind of the regulatory question as a collective group.
Yeah, privacy is an interesting one because with these over collateralized stablecoins, lending is a very key point, or a very key way that these stablecoins maintain their value. It's entirely how they maintain their value, actually. And lending is fundamentally competitive in the sense that if you could change the price of someone's collateral, you could liquidate them profitably, and obviously the borrower doesn't want that. So in the case of totally transparent loans, obviously everybody's collateral and loan transactions are totally public. That is one of the selling points of these distributed ledgers in the crypto space. But with the privacy, you could take out a loan totally privately. No one will even know that you took out the loan. No one will know what collateral you used. No one will know what your liquidation price point is, and that makes you resistant to market manipulation. So, a use case there is if you're an ETH user and you want to put some money into some high risk position, and maybe there's not enough liquidity there, and you're afraid of being targeted and liquidated, bridge your money over, lock it up in a private loan, and no one's going to know. No one will even know that you even what you did with your money after you bridged it. They won't even know you had loaning on your mind. So that is a really, really nice advantage. And it's not even unique to Silk necessarily. It is right now, but the ability to use the network for private lending is available to anyone in the Cosmos if they use the contracts to do it. So it's something I'm certainly excited to see more of. And I think it's a pretty big selling point that is only really now just coming to the surface.
100%. I'd also add to that I think in order for us to bridge back to commerce, which was one of the earlier questions, I think we're going to have some form of privacy for businesses. Like imagine you're running all your commerce on a blockchain and timestamps are publicly visible, the amount, maybe the product. Like we can't do commerce without privacy because privacy is a protection and it's a security. So anyways, just wanted to quickly give Christian a chance to talk about that since he was the last.
But before you go,
before we
leave the mechanism question, I want to respond to something that Sid here said, which is that Luna was an experiment. And because we have this collection of people, one of the key things about an experiment is you can talk about whether it's good or bad. You can have a discussion about it, and have it not be the case that saying anything negative just gets shouted down, right? The economics of Luna were insolvent. They were bad from the beginning, and people understood that. But the cult of personality persuaded a lot of people to stick their necks way out, right? And, I've been concerned historically about FRAX because they've got a little bit of that same thing, but they're actually an experiment. You can talk about it, and they've got a good point that, well, if it's only this little bit and we've got a knob, maybe that makes sense, and it deals with over-collateralization. So it's really interesting, and it's an experiment. But if any of us here or any other project starts going into the realm of shouting down an objection as opposed to having real direction of it, that's a signal that we should pay attention to. But otherwise, we really want the experiments, but we want experiments that are really focused on giving real solid economic value as opposed to trying to take control of the network or doing a money grab. And so, this crew does, is really bringing a lot of value to that overall, stablecoin ecosystem. And I want to note that particular distinction as we all go forward.
Yeah, I appreciate that, Dean. And indeed, for 2 years we've had a perfect peg, and a lot of stuff is indeed FRAX is an experiment, and I appreciate the confidence there. And yeah, obviously there's been a lot of feedback, right? And like I said when I was just actually talking, perhaps honestly FRAX should approach 100% CR and do the thing that everyone was talking about. Is the ideal thing on chain is 100% CR. like it was said, like fiat coins don't suffer from this over collateralized, under collateralized thing. They just always can stay at 100%. So perhaps the end game for the FRAX tech is to demonstrate that you can stay essentially at equivalent 100% CR without, you know, extreme inefficiency, but without insolvency, right? So I totally agree.
Yeah,
So,
Dean,
Sam, just out of curiosity.
Oh,
Right.
I was
Yeah,
gonna say, just appreciate, Dean, the fact that like we have an ethical responsibility as a group to design good experiments and to have a dialogue, because social dialogue is a form of risk mitigation against bad experiments being attempted. So I wanted to jump in there. We are going to pivot to the regulatory question. Stefan, you had something you wanted to say. If you can keep it like under 30 seconds, you feel free to jump in there.
Yeah, no, I wasn't going to say anything. I was just going to ask Sam a question, really. You know, and he and I have spoken about it in the past, and now with Binance, right, having a run on their bank, if you will, you know, over, I think, course of 2 days, having to release $6 billion worth of Bitcoin. One of the things he says is that we in the crypto industry shouldn't comply with the traditional fiat banking approach of fractional ownership, right? You know, what's our collective thought maybe here, you know, just not only to Sam, but is this something, you know, we should be 100% collateralized, or is this something, because it's digital money, there's a much faster run on the bank than you would expect in the traditional actual paper money world of the fiat, you know, legacy?
I think there's a good distinction here, and this actually goes right into the regulatory discussion, is I think there's a good distinction between economics and regulation. So we're about to talk about regulation, but I think economics are kind of sort of like laws of physics, where it's like, it doesn't matter how, whether something's a digital market or like a traditional market of like finance and papers and MySQL DBs or something like that, the rules of markets, of bank runs, of interest rates and stuff still apply the same way. Now, whether the laws and regulations are outdated and they should say something else, like, for example, I don't think that many people agree anymore in the year 2022 that you have to have at least $1 million of net worth for your own protection to be able to make the decision to whether to invest in something or not, right? So like that is something that is a regulatory law that should not be the same with digital markets. When you have the internet, when you have adults making decisions about what they want to do with their money, they can go to Las Vegas and gamble it. But if you say, oh, this is gambling for digital assets, it's all of a sudden not allowed unless you outlaw it and make it as difficult to do as like a IPO of like a multi-billion-dollar company, right? So I just want to have like a good distinction. I agree with regulatory stuff should be different. I don't think that the same laws about, you know, 100-year-old or orange orchards and securities offerings and stuff necessarily applies to a lot of the digital assets today, right? But capital markets still behave the same way, whether they're you know, digital or whether they're traditional and analog, right? And so those kinds of things are indeed the same, in my personal opinion.
So that being said, we'll start off with Dov and Sid on this one, specifically Dov. You can kick us off here. What is the role of regulation? It's a question there. And then what is the role of regulation tied to stablecoins? And where do you think we're headed? And what do we need to do as an industry, a collective group of builders trying to find that ethical line of compliance versus progress?
Yeah, it's a great, yeah. I mean, and just basically what I'd say is I agree with Sam there, but just to add on to that, it really is a tricky one. So just to give you one example, there's been this whole concept of, do you allow your own native token as collateral for your stablecoin, right? And just a few months ago, that was seen as being completely okay, and then suddenly that became not okay. So, which I totally understand, but I guess I don't think the answer I'm going to give is going to be very definitive. But all I can say is that I think at the moment we're definitely in this weird cauldron of being definitely between regulation and progress, just like you said, Carter. But I think that we have a ways to go basically before we can just say, okay, we're breaking away as this, completely digital entity, and we just get to go and make our own rules. Unfortunately, that isn't the case right now. We all know that. I think especially you guys in the States, right? There's a lot more heavy regulation. You've got to be a lot more careful. But what I will say is that I think technological advances do tend to push the progress that we want to see. It has happened before, it continues to happen, and it's never an easy fix. So this isn't like a definitive answer, of course, because no one has it, but I think that I think, Dean, you said it earlier, that everyone in this panel now is actually searching for something that is legitimate, right? I don't think there's people on here that are trying to do something that is going to scam people. We are trying deeply, as we've all said, post UST, post everything that we've learned to grow and make something better. So I don't know. I honestly think the answer in pretty much both those questions is just to keep doing what we've doing. Like try and have honest people rise to the top. Try and have like honest practices in your designs rise to the top, and then to just keep on making sure that we are pushing the envelope, obviously in terms of tech, but what can we do? We have to toe the line, right? Like, for example, the kind of, and I know I call them regulations because I don't even know what to think about them. If you think about someone from outside of the US, it's hard to even know, truthfully, what the actual law is. Sid, you probably feel the same. A couple other guys on this chat. It's like, is this a global law? Like, but at the end of the day, I think it's the responsible thing to do to look at I guess we can call it the sort of like general crypto law that we all look at and read and perceive, and then just keep on pushing forward and making sure that we can make inroads, because this isn't going to be a quick answer. So yeah, it's unfortunately, yeah, Carter, it's not something I can answer quickly, but what we are doing at Kujira is making sure that we stand by the current, laws, regulations, as I've just said, however you define those, because they're very, very loose and very confusing. But at the same time, I believe that if we keep on, like we're all doing in this panel, pushing for something that isn't a huge experiment, let me put it that way, and isn't something that, look, if we're all talking about over collateralization in some way or form, I think we're on a good wicket. So yeah, long story short, I think that if you think about it, we have made great progress. So, I mean, I think we all look at these huge doom events as being like, I think all of us here, we think, oh, we've gone back 10 years, but we haven't. We've gone back like 5 minutes. So I think doing what we're doing at the moment, pushing forward with responsible methodologies is the only thing we can do. And then continuing to just, balance this weird curve between some, crazy regulation and what we think is right. And I personally believe that if we keep on pushing in this direction that we all are, I think we'll get somewhere. We won't get all the way, right? We know, like, we're intrinsically against, like, sort of, I guess, the ultimate government policies, but we'll get somewhere. It's kind of like inch by inch. It's not going to happen overnight. So I personally believe that what we're all doing here is going to result in multiple forward steps, but yeah, just not like not a win overnight. But yeah, I know that's a bit sort of round the houses, but that's all I mean. We just keep going as we are. Let's not get sucked into scams, and let's try to do right by people. And then I think we talked about someone mentioned a consortium. I think stuff like that is a good idea. Approaching, I think it was you, Stefan, approaching various vendors, various people that can help us actually get this stuff over the line, get decentralized commerce over the line, get our stablecoins over the line in a real world way, even if it's in a small way. Let the powers that be see that we can actually do something real, that we're not just playing in this sort of like what they feel is some like, scammy crypto bubble. We know it's not that, but we got to think about how they look at it. So yeah, a lot of work and backwards and forwards, but we are all taking the steps forward. I believe that.
Yeah. I love the answer. Before we hand it off to Sid for his answer, I think what's super interesting is you said we only went 5 minutes backwards, And
Yeah.
that's such a purist, optimistic builder mindset. And I love that because we need to maintain that enthusiasm about the technology. I will say this, trust took a massive hit for our industry from what happened. That's like an undeniable, real effect that we've all felt. So I just want to jump in there because I love the optimism. We have to have that. Now, Sid, ball's in your court now, kind of the answer to what is regulation? What is the role of regulation tied to stablecoins?
Yeah, I think I'll say two things here. One is kind of like a personal experience from dealing with regulations and being a builder. So one of the products we built out in 2019, which was the commodities trade platform, we actually had an integration done with Western Union in Singapore. We did have an on-chain stablecoin back then, which was essentially issuing a single dollar on the chain against a single dollar in a fiat deposit in a bank account. And we were able to produce on-chain proof of reserves at all times in 2020, where every user of the platform was able to verify if that dollar exists in the fiat account real time. The issue there was, as soon as we went live with this in 2020 is when Singapore introduces the new law called Payment Services Act, which created a licensing requirement to run this. And that kind of got in the way of us actually rolling this out in production. So this is like, as a builder, Dove rightly pointed out, when you're sitting outside of the US trying to understand how US regulations affect you, it's a huge gray area as a builder. You're kind of navigating
It's not better inside.
a whole realm that it just doesn't make sense to you on the outside. I can't imagine how hard it is on the inside. So that's one aspect of it. And I think the second aspect that I wanted to point out to, which I think I mentioned on the podcast with you as well, Carter, earlier on, is that I feel going forward, there's also going to be a concept of user enforced regulations, where, just a quick example, if today all the centralized exchanges start publishing proof of reserves, the ones that don't, users would automatically gravitate away from those towards the ones that do publish, on-chain proof of reserves. So similarly, I think as users kind of become more aware of what they're dealing with when it comes to stablecoins, they will start to move towards the ones that they believe are safe, which in some ways kind of like a user enforced regulation, where users are banning themselves from using not safe mechanisms or not safe products and gravitating towards safer products. So I think that is also going to be a strong force to be reckoned with, or to be considered going forward, because each FTX collapse or each Luna collapse we go through is also education. More and more people, of course, burn their hands in the process, but learn a lot more coming out of it at the other end. So I think going forward, as long as there's enough information that's available, as long as users are kind of able to choose the right path, make educated choices moving forward, it will kind of lead to a natural grouping of usership towards safer practices and safer stablecoins, where it kind of becomes a de facto regulation from the users themselves.
And one thing we can collectively do as a group is, like, not only is there the user education, but there's also the regulatory education, and we can all collectively, as stablecoin projects, team up. And as the time comes, we can all lean on each other as resources to try to tell the story of, like, this is genuine progress, So that being said, final 10 minutes here. Want to pivot to a question that's near and dear to my heart, and it's tied to the risks of centralized collateral in 2023. Like, we have this ethos of decentralization, but then we also have this ethos of, like, stability that needs to be maintained. So we'll kind of go Christian, Dean, Tadao, and if we can fit in Stefan and Sam to kind of round things out, that'd be awesome. We'll see how fast we can go here. But, like, what do we, like, the risks of centralized collateral? How do we deal with that as decentralized projects? Where's the demarcation? And Christian, if you want to kick us off.
I think Zaki put it the best, which is the whole idea of plurality. Everybody's going to have a different appetite for centralization, and everyone's going to have a different perspective on how to utilize centralization for their project. And I mean, look, there's 7 of us here right now with all separate projects. There's plenty of room for different levels of centralization. Certainly from the perspective of Silk, we pretty much go with no centralization. Like, that's the ethos. The whole product is entirely based on decentralization, and that's just what the product is. And that's an interesting problem that we've kind of put in front of ourselves, because centralized assets are pretty good. USDC is the best stablecoin, and if you wanted to create uncorrelated assets, you have to pull from a place that's uncorrelated. And what's uncorrelated? It's centralized, it's off-chain, it's all regulated assets, it's real estate, it's commodities, it's you have to accept some amount of centralization, at least right now, if you want to be more flexible, essentially. So I personally actually don't mind centralization that much. I mean, I'm subject to the laws of the country that I live in anyway, so it's not that different that the money that I use is also subject to those laws. But like I said, I think it's the best answer is to leave it up to the users and let people congregate on the projects that fit their ethos, and there's plenty of room for all of us.
Awesome. Dean, what do you think?
So, so this is a little bit tied to the regulatory question, right? That you sort of have this spectrum, and one of the key things that people need to understand is there's sort of, you know, the account-backed, what you've been referring as sort of centralized, the sort of asset-backed, computed one like like MakerDAO is the usual on us, several of the people here, and the algorithmic on the other end. And we've seen bad algorithmic like UST, but there are good algorithmic in the future, and we need people to understand that what we actually want is economically sound. Centralization, you know, people bandy it about when they want to kind of, you know, it's like calling, you know, it's like in every Harry Potter, everything bad was dark magic, right? You know, it's if you have enough independent assets that are all, quote, centralized, you are decentralized, right? Every validator in a proof of stake chain is centralized. It's located somewhere. But if I've got enough of them with enough different disparate interactions, I can build something decentralized on top of that. And so what you need is a broad collection of possibly off-chain, possibly on-chain, you know, possibly bank accounts in one currency versus another, possibly real estate, et cetera, that are independently regulated in different jurisdictions, right? You know, that gets you back to a world where you're decentralized as a stablecoin because you are combining all these sources of value that you can build your stablecoin on with appropriate risk management around them, right? So you don't take a deep dependency beyond what a particular facility might provide. So, you know, same with bridge risk. There's a lot of people that are really concerned about bridge risks because there's been a lot of bad bridges. But when you have the newer generation that are a blockchain acting as a bridge, then you have substantially reduced bridge risk, but bridge risk is just counterparty risk. So, you know, an asset over Axelar is a different risk than an asset over Gravity. They both have this additional risk, but, you know, is it really that much more than the smart contract risk of the contract on the other side? You know, maybe it is, maybe it isn't. If it is, you lower the minting limit, you make sure that you've got coverage for that risk and so forth. But as we move to a richer economy, because frankly, right now, the blockchain economy is still quite simple from the point of view of an economy. But as we move to a world with deep perp markets, deep perpetual markets, now you can start to do things that are real innovation, you know, that you cannot do in the modern market that's not on a blockchain, like delta neutral stablecoins, where you would not want to have your entire stablecoin relying on that particular asset, but you'd like to be able to incorporate that mechanism, which is truly novel and truly an advance over anything that can be done in the off-chain world. And now we start moving into a world where on-chain stablecoins are less collateralized and yet still low risk because, you know, you've been able to assign the risk, separate the risk, have it be people that understand what they're doing and can manage their expectations. Similarly, when you add in slashing, you know, the equivalent of slashing insurance, or I can put in, you know, bridge risk, eventually you'll have a market where people can have insurance against bridge risk and then it's a non-issue. You'll have liquidation insurance, which lets me now, instead of being even 120% over collateralized, I can be, you know, 100% over collateralized, and I'm paying a fee for someone else to cover the risk that my asset falls. All those kinds of things require the richer environment and cross-chain economy that we've all been building towards, but that'll evolve over time. And so one of the things you need in this world is regulation, if we're going to have it, which we are, that is permissive of mechanisms, and it's about what we want to accomplish, not how we're supposed to, so we can evolve going forward. And then, you know, having it be centralized assets is fine, right? You know, that's just, it's got a place in the role of the overall on-chain stablecoin ecosystem.
Awesome. I love, there was a lot of nuance in that answer. Tadao, do you have anything you'd like to like to add on the risks of centralized
Yeah.
collateral?
Yeah, so Dean was talking a lot about the diversification need. I think the other side is the transparency need. So I think one of the biggest problems we've seen with I think FTX being the biggest example, what we can see with 3xZ and then all the other examples, just lack of transparency, where you have this, I think, fake trust that a auditor that has been selected by themselves will actually be to your benefit. So let's say in a perfect world you have full transparency of the centralized entities, then you reduce the risk, I think, massively. I think that whenever we've seen problems on chain, let's say bad debt happening at Aave not that long ago, it's fine because everyone can see it. Luna, for all its problems, it does have the merit that we could all see what was happening at all times. So if we're able to achieve that, we're able to achieve bringing real assets on chain that are actually properly verified, then you stop having. I think you stop inheriting a lot of the issues that we usually just all packed together as like centralization problem. I think we get there, we'll be in a pretty good place.
It's interesting. Essentially, the centralization. If you have enough decentralized options for centralized things, it becomes decentralized. Love that answer from Dean. And then Tadao, you're pointing out transparency as being, extremely valuable component. Even if there is centralization, at least we have this on-chain visibility that strengthens these systems. Stefan, I'd love for you to jump in here for any of your perspective on regulation, and then we can close out with Sam, because I think also the centralized collateral question. I know with FRAX that's come up many times before with X percentage of FRAX is backed by USDC and how you've thought about those. But
yeah,
we'll
I mean,
Stefan,
I think.
Did we I think we lost Stefan. Oh boy! All right. Well, we lost Stefan.
Oh,
now he's back. Maybe. All right. We'll wait for Stefan to come up. Fisco, if you want to pull him off stage, we can wait for him to come back. Sam, what are your thoughts on centralization of collateral? This kind of the trade off and the criticisms that can be tied to it as a useful tool.
I think Dean had a great point in terms of, validators are real world assets, right? Whether they're, servers or they're, proof of work Bitcoin miners or whatever, right? And so it's not like blockchains themselves don't have real world assets of sorts. It's just who owns them, right? Is it one corporation that owns them? Is it a diverse global, set of people? Same thing with FRAX in terms of, or stablecoins in general. Like, FRAX does have a lot of exposure to USDC. It also does have DAI exposure too. Transitively, we have protocol controlled liquidity in some of the largest curve pools, like 3CRV, and including our FRAX BP. And one of the things we try to do is actually the same thing in the spirit of what Dean was saying, is that, we try to not own all of these stable coins in like a single smart contract address, that if push comes to shove, it's very easy for like one or two fiat coin actors to blacklist and then figure it out later in court or something like that. Basically what's going on in like bankruptcy court, right, which takes like years and years with all these lending and FTX and all these things. So in order for FRAX to kind of get wrecked, so to speak, right, in terms of some of its stablecoin collateral, they would have to blacklist hundreds and hundreds of I don't know, maybe a couple thousand perhaps stakers of like Curve's 3CRV pool, FRAX BP pool, users of Convex's staking boosters, and all these things, because all of those would freeze, right? Because you can't call the transfer function on USDC or Tether or whatever to actually make any kind of swap. So we do try to have that kind of ethos. So like I really did vibe with what Dean said.
Awesome. Stefan, do you have any closing thoughts now that you're back with us? Any closing thoughts on regulation or centralization of collateral?
Yeah, no, I think what Dean said and what Tradio said were really interesting comments, right? I mean, I think the industry is regulated. And let's remember why we set up decentralized solutions was to build a new system that's ready for a modern environment, right? The old systems, the old regulations are not ready for these new systems that we're building, and were built out more than over 100 years ago. So what are the new regulations that need to be put in place, and how can the communities start governing, you know, those regulations, and how do we put those in place? Transparency is really going to help us create more insight into what we're doing and how we're operating these businesses. But already in crypto, we already are more transparent than any of the banks. We are 100% collateralized, or 98% collateralized, or 90% collateralized compared to the fractional reserves that the traditional finance and the regulated finance is operating under. The entities that went down are regulated, centralized entities. They're just not regulated by the US because nobody knows what the decision is in the US. So you know, it's all ad hoc and totally arbitrary in terms of how regulations are governed and managed out here in our environment. So much so that developers are leaving the US. They're going to Bahamas, they're going to Cayman, they're going to Lisbon, they're going to Dubai, everywhere else, because it's just too difficult to navigate in this environment. So, I mean, that's ultimately all I'm saying is we continue to build in a decentralized world. We need to create the trust of the community, and our moat is not a regulatory, a compliance moat. Our moat is the appreciation that the community has in the product that we build. That's what we're out here to do. And if they require more transparency, then we are transparent, right? Look how competitive we are. I mean, we're all against each other. We're holding each other accountable. We're going to hold each other accountable as a industry. Then the community will then try and also hold us accountable. I mean, they'll dig up all this stuff. They find out what we're doing. They know where we tweet. They know where we sit, where we act. And that all is my view, how we should be operating. And if we never take custody of the customer's funds, then I think we are operating in a much more jurisdictionally friendly environment.
Well, I think that's a strong way to close it. In summary, the future of stablecoins is bright, and we should never lose track of the fact that these systems do create genuine value, and it's our role to evangelize and spread it as such, and to also hold each other accountable throughout that process. So overall, really awesome panel, guys. I was nervous about having this many people on one call, but I think we really dug in. We didn't go a mile wide, inch deep. I think we actually got to dig in here a little bit. Thank you all for your insights. I would love to invite you back to the next Stablecoin Summit. In person is the hope. So just know that invitation is here, and we can do even deeper stuff and more nuanced panels. But with that being said, thank you for your time. And it was a lovely panel, guys.
I think I can speak for everyone to say thank you, Carter, for hosting this. You did a fabulous job.
Yeah, well, shout out to Fisco, our business development guy. He pulled everyone together. He's the silent hero as we speak, moving everyone around and putting on music and stuff. So huge shout out to him. Yeah, lovely team. You guys at Shade are amazing. Thanks so much, everyone. Thanks and all the speakers, guys. Ciao. Bye. With that being said, we'll be now taking a quick. I need like a 60-second break to 90-second break. Grab some water. We'll be back with the infrastructure panel. Don't go anywhere. Be sure to like and subscribe. Be sure to retweet all those.